Well, yesterday's surprise inflation numbers has quickly had economists reconsidering their interest rate calls, with a growing number now expecting a rate hike in August. I'm joined now by Business Editor Ross Greenwood. Ross, say it isn't so.
No, sorry, it might be so. That's the reality. But certainly the odds of a rate increase are increasing, Laura. And the reason for that is because the Reserve Bank has, right up until now, said it is watching inflation closely. If it gets out of hand, effectively, it will have no choice but to raise interest rates. And so just to give you some sense of what this means, money markets, you can kind of judge what they think are the odds of a rate rise or a rate move into the future. And so before the inflation number dropped yesterday, the 4% number for May, the chances of that rate hike in August were said to be 11%. Afterwards, right now, as we sit here, it's 37%. So it's not more than 50%. No, it's not sort of, if you like, a one-on-one chance. The reality is that the big four banks, though, are now starting to rethink their interest rates. Now, say, for example, the NAB thought the first rate cut would come in November this year. It now says it's sometime in 2025. The ANZ previously had said it would be this year. It now says February 2025. The Commonwealth Bank is under review. Westpac is sticking with its forecast that the first rate cut will come in November this year. But that just goes to show how important that inflation number was yesterday in regards to where it goes to. I want to show you something else. This is what money markets did. So you can see here on the left-hand side of this chart that just above 4.3% is where one-year bond yields were, interest rates. Have a look what they did straight afterwards. They went straight up in the air and effectively now are almost 0.25% higher than what they were yesterday. Now, what that says to you is that money markets are telling you that they believe that the inflation number was a shock, and as a result of that, they are responding by pushing the money market rates higher.
Right, okay, so what was in this data yesterday? Because it wasn't the quarterly inflation data, it was the monthly read on things. So why was it such a surprise? What was in these numbers?
Okay, so everybody understands, I think, that the Reserve Bank is waiting on quarterly numbers which drop on July 31, so quite a way off. But these numbers for May were supposed to be down at around about 3.8%, ticking slightly higher. But when they came in at 4%, and because they included even more services in them, which is what the Reserve Bank is looking for, that's the reason why. But the other thing is, have a look at where it has gone from. So inflation's trended all the way down to the beginning of this year, 3.4%, 3.4%. Treasury, the Reserve Bank think it's going to trend lower from here. Perhaps takes a bit of time, but shouldn't really be spiking up. But then it spikes. And that spike there is the problem. Now, notwithstanding the fact that Jim Chalmers went into Parliament yesterday and argued uphill and down dale that this wasn't so, the reality is that this is the number that the Reserve Bank looks at, the trim mean. Now, it actually strips out some of the one-off factors, but the point is that that number is starting to rise and has come from 3.8% in January to 4.4% in May. And that's the reason why the markets are spooked. That's the reason why they're now suggesting more rate rises. And this is what's rising in price. Sticky stuff that you can't easily get out of our economy. It's insurance. It's the price of health, the price of education, the price of transport, the price of housing. These are all things that people can't avoid. And so if these prices are rising because of wage rises, because of the fact that inflation is becoming sticky, there's only one way to get this out of the economy, and that is for the Reserve Bank to raise rates, or indeed for the government to cut back. But of course, that's not the plan, because from July 1, there is going to be more government spending in the guise of the tax cuts that will come and the cost of living relief as well.
Okay, yeah. Yeah, that's right. And when you say these are all things that people can't, these are essentials that people aren't going to pare back on, I was going to ask you about that as well. There's going to be more money in the system with those tax cuts. People will have more money in their pockets. So we could be looking at perhaps more than one rate rise this year, couldn't we?
Generally, the reality is, Laura, that interest rate rises or cuts are like buses. They don't come one at a time. They generally come two or three at a time. And that is possibly likely as well. So the fact of the matter is that if you get one, you're just as likely to get a second to make certain really they've done the job that they want to do, which is to crush demand in our economy. Remember that the Reserve Bank is on an experiment that's never been succeeded or tried really anywhere else in the world. And that is to try and have inflation drift lower lower over a longer period of time while maintaining full employment. But if all of a sudden they see that inflation is getting out of hand, they'll hit us with more interest rate rises to try and get rid of that demand, which of course also has the potential outcome of pushing the unemployment rate higher here in Australia as well.
Yeah, right. Well, the jobs market pretty strong at the moment. The markets didn't react well yesterday to this. So what's the expectation today?
I've got to show you that it's actually really poor. So yesterday wasn't good on our stock market. So I'm showing you the Dow Jones here. It's up by 15 points. So it's pretty flat. So you'd think maybe our stock market today would normally follow that. But have a look at what the share price index on the futures market says our market's going to do. It says it's going to drop 85 points on the start. And that is all about interest rates. That is all about the banks getting hammered. That is about retailers getting hammered. That is about property companies getting hammered. So anything that is interest rate sensitive is going to get knocked about on the market today simply because of these reforecasts of interest rates, simply because of that inflation number that dropped at 11:30 yesterday.
Ross, always good to see you, even when you're talking about a rate hike in August. We'll see you soon.